Hi, everyone. My name is Rubsun Ho. I'm with a company called Crowdmatrix. What we are is what a lot of people would coin an equity crowdfunding platform. The idea is that it's an online platform to help issuers raise money. To this gentleman's question, I think it's an interesting point. There are a lot of, what I see is there are a lot of foreign platforms that kind of operate peripherally in Canada, and sort of, it's the thing with the internet is you can't put up a border. So there are platforms that are raising here that kind of raise money for Canadian companies and probably sometimes raise money from Canadian investors who are unregulated, and that is sort of a part of the playing field that's a little bit unbalanced for domestic players. But I'll defer to Pat, but I think as Cato sort of said, if people aren't pushing the boundaries, I don't think the regulators are going to respond as quickly or evolve as quickly as they'll need to. So to that point, I'm a lawyer by training, so my investors were kind of like, when we started, they were really banging hard to get going, but we went through the whole regulatory process to get registered. So to operate as a crowdfunding platform in Canada, we had to register as an exempt market dealer. That was a process that my lawyers told me would take about 3 months. It ended up taking just under a year, and cost us over, it was a six-figure bill for a startup, which was pretty significant. I'm going to tell you a little bit about the business, and then maybe we'll talk a bit about some of the regulatory challenges we face. So we started as a platform primarily for raising money for startups. It was a syndicate model. The idea is to help small companies, startups have an easier means of raising capital. And our model was to take term sheets and deals that were already being done. Term sheets are being led by a venture capitalist or a sophisticated angel investor, someone who's a professional investor, and then putting it online and then allowing accredited investors to come and invest alongside. So we would aggregate a bunch of smaller investments from accredited investors and invest alongside the lead investor, the professional. What we found, we only launched in August of last year. What we found is that just the market is not as quick to grow as we had hoped it'd be. It's not clear if it's a Canadian thing. People talk about Canadians being risk averse, but as the statistics here will show, there's $120 billion raised in the exempt markets, and for junior mining companies, there isn't a better jurisdiction in the world that you go to find early stage, very risky capital. Some people might say the regulatory environment makes it a little bit tougher here. I mean, relative to the US, the UK, even New Zealand, the equity crowdfunding market here for startups is way undersized, which, from a policy perspective is problematic for these, innovation companies, these companies that all the governments are getting on the back of and are trying to promote. Their challenge is still primarily raising risk capital, early stage seed capital. So what we're doing is we're kind of pivoting a bit. What we're doing is trying to, whereas we were kind of a boutique store where we sort of sold one product, now we're looking to expand our product offering. So we're looking at the whole alternative investment market, alternative assets, and the private markets in general. So as these statistics note, $120 billion raised in Ontario alone in private deals. A lot of that comes from big funds, big banks raising, billions of dollars in bond offerings. But there is a lot of still 40 some odd billion dollars worth of non-fund issuers. And what you'll see from the statistics is that, even though they're responsible for a lot smaller amount of the capital raised, there's way more transactions being done by these types of companies. So which means there's a lot of companies raising small amounts of money. And, in the marketplace, some of these companies might be able to make use of an intermediary, an agent, or an investment bank or broker. But those guys won't touch your deal unless, it's at least $10, $15, $20 million, because it's not worth their time and their money because of the resources we have to put in. So that's the market we're looking at, is these unbrokered private deals, helping them with a way to raise their capital. And our proposition to investors is that, everybody needs a little exposure to alternative assets to diversify their portfolio, to give them a non-correlated asset class away from the public markets. So whether it's real estate, whether it's private equity funds, the biggest benefit of these things is that these managers, these people managing these companies, aren't focused on their share price. They're focused on building a sustainable long-term value for their shareholders. So if you look at the big institutional investors, Yale, Harvard, CPP, they've all driven their returns through a bigger allocation towards alternative assets and private deals, a lot of infrastructure, real estate, private equity type funds. And so this was initially a nicely animated graphic, but we had to translate it to a PDF. So really what we're doing is we're coming to these issuers on one side. So it could be a private equity fund, real estate developer, real estate fund, junior issuers or even senior issuer public companies doing private deals. What we're saying is like all these guys now are all doing the legwork of trying to find investors. They're out hustling, they're out making phone calls, and they're soliciting these investors on their own. What they need is distribution for their product. They need a way to get their product out in front of as many investors as possible. And it kind of doesn't make sense that this effort is being duplicated by every one of these issuers every time they raise capital. On the other side of the equation, you've got investors that are looking for different assets to invest in. They are looking for different types of returns and exposure to things that will help diversify their portfolios. So right now we target accredited investors, which would sort of encompass the first three groups. What we hope is that, and this kind of goes to the regulatory part, we could target retail investors as well. We're allowed to do that, but the administrative burden of doing so is just too high. Like, it's just not worth it. If someone wants to give us $500 who's like a retail investor, we got to do KYC. We got to we got to call them. We got to make sure it's suitable. We got to check their ID, do all that stuff. So it doesn't make any sense. But what that does though is it takes out a big pool of capital that would otherwise be available to some of these issuers. So our model is really to create a marketplace and facilitate, instead of a many-to-many relationship, it's a many-to-one-to-many. And what we hope that will do is what it's done in all these other marketplaces, right? It's created this efficiency so that in 2 seconds right now, I could book an apartment in Zagreb, right? Or I could go find, I remember when I was practicing law, there was a guy who had a driver. Like, it was his guy. Anytime we went out, he'd call his guy to drive us wherever. Now you've got the power of the internet to be able to give everybody a driver, right, at any time. Somebody making crochet cozies in Denver, Colorado can now sell that to somebody who likes crocheting in London, England. So that's the power of the internet in connecting these buyers and sellers has never really been deployed into the financial markets until the last few years, which is the whole reason behind this FinTech explosion. So the issues we're trying to address is right now is the exempt market is very opaque. As an investor, you're kind of limited to the relationships that you have. So rarely do you go find an investment. Usually the investments come to you. This is what someone said to me when we started. He's an former investment banker. He goes, Rubsun, you're gonna have problems because deals are not bought, deals are sold, meaning that you can't expect to create a market where people come and buy your financing product or buy your security product. And I think to a certain extent he's right. We are finding that with a lot of our deals, we're actively trying to call people, follow up, create a sense of a fear of missing out to get them investing. But it's very reactive from an investor perspective. You can't be proactive and go find some of these deals. Somebody want to invest in one of Troy's funds, unless they knew about it, unless they knew to go find it, they wouldn't. There's no discovery process there. Issuers are burning too many resources. From the regulatory side, again, a lot of these investment bankers and intermediaries, they won't get involved because the regulatory administrative burden is too high for them. So what we hope is that we can utilize technology to give people more access and more visibility into this marketplace. And by using this technology and making things more efficient and making the onboarding more efficient, we can take smaller amounts. We're still looking at accredited investors, but we can allow an accredited investor to invest $5,000 into a venture fund where normally the minimum investment would be $100,000, right? Because we can handle all of the documentation and the reporting and all that stuff through an online portal. Over time, as we build our investor pool, it's kind of pre-screened and is available for targeting. And if we do get into sort of the retail side, we can very easily sort of market to the right audience. We can pick and choose from a regulatory standpoint who a certain offering is available to. And to Troy's point, I think you'll see a lot of due diligence. We have, as a dealer, we have this know your product obligation to kind of do due diligence on the offerings that we're selling, which can be time consuming, can be resource intensive. So to the extent that we can use technology to automate that to a certain extent, that will bring down the transaction costs. So right now, our model is to work with lead investors. We have been talking to other sort of dealers, and this is the kind of marketplace. We're really just trying to be an enabler, sitting in the middle of these existing capital flows where money is already going through these different vehicles. And whether it's a dealer on this side who's presenting the deal and a dealer on the other side who's representing clients who want to invest in the deal, we're hoping we can be that broker to be the intermediary to get those deals made, take our little piece of it, and make sure it all kind of complies with whatever regulatory obligations all of the parties have. What we are also finding is that in Canada, this is an interesting market, but most people are here, right? Which explains the growth of robo-advisors. They're very passive investors. They rely on their investment advisors to find them products. And from the advisory market, it can be very difficult to get these alternative assets through that channel because of compliance issues. Because we don't ever think we'll ever be able to sell any of our products through, say, an RBC or something, because their compliance group will just never allow these private deals onto the platform. Maybe at some point when there's some technology that kind of can give them some comfort about their own KYP obligations, then maybe there's some hope there. But we're looking just to be the intermediary to apply whatever technology is available. We're not necessarily going to develop everything our own. We're not necessarily going to be the smartest kid on the block. We're looking for tools that we can bring to bear onto this marketplace. In terms of where we're going, right now we offer direct offerings. All the online document closing and KYC and document storage is enabled. On the product side, we're adding some different private equity funds and talking to some real estate developers about their types of deals. On the functionality side, we're looking to build out sort of a CRM to help people kind of target their investors when they come in. If you've got a yield product, we can target investors that are looking for a yield play. Again, we're talking to different partners to kind of get our products out through different channels. And then sometime in the future, I think when we bring enough buyers online who are exempt, who are accredited, or who fit the criteria for exempt market purchaser, then you can create a secondary market for these privates. So that's one of the biggest downsides of an alternative or a private deal, is that there's no liquidity. But if you can keep it within the closed loop of approved buyers, and there's enough of them to create a marketplace, then we can start offering liquidity on that side. And that's happened in the US for a lot of companies. And we see, again, we're not going to develop any of these solutions, but as you'll hear later this afternoon, blockchain solutions for KYC, blockchain solutions for shareholder ledger, as well as, just as importantly, the settlement and payment of funds, right? To bring funds in, pay funds out when there's distributions, and that kind of thing.